Welcome back to Primary Source China Investment. This week, we're on show L7. And if you look at the calendar, it's Thanksgiving here in the States, which means it's almost the end of the year. And with a few weeks left, maybe 5 weeks of trading left in the year, let's look at what happened with China equity. There are 3 key points. 1, bigger did better. 2, timing is for losers. And 3, brands are not stocks. So let's get into each of those. And the first one is bigger did better. Large cap outperformed small caps. The CSI 300 is up about 15.5% year to date. And the CSI 500, remember, CSI 300 and then the 500 is below that, is up 10.24. Another data point is one of my favorite sectors, tech and telecom. The large state-owned enterprises like China Telecom, China Mobile, China Satellite, tech and telecom was up 39.3%, while the Star 200, which is the tech and innovation board, is down 8.07. Finally, banks, like our favorite China merchants, the sector was up 23.63, and China Merchants Bank specifically up 32.9% while paying a 6% dividend. Some of the other interesting notes on sectors, consumer discretionary was up almost 19%. It outperformed consumer staples, which was down 3.5. Materials were up 13.23. Energy was up 10.3. And finally, healthcare was down 8.38. Hongguo, anywhere you want to go with this? Any thoughts that come to your mind after hearing all these numbers?
Yeah, probably just if you go back, just review the market for this year, it's pretty clear to see after the 2-3 years drop, and it's reached the bottom area. Bottom area, like we talked about it in the previous show, doesn't mean it will get it's up.
Right.
So this primary driver for this round of the go up is really came from the government policy. So they push the greater policy, obviously larger player get benefit. Obviously, in the weak market, dividend related companies get better priced. So a bank, obviously, in China, entire financial system, bank definitely is the monopoly entire the financial system. No any other subsector or other companies can compete with the big bank. So that's definitely makes sense for the big player could performance much better than others. And also, I think the repurchase is become the topic in the market. So that's a repurchase of really supported the stock price.
Yeah, so some of the bigger profitable companies, and maybe energy is someplace to look for that. They're big and profitable. A lot of the, so old line tech and telecom, those are going to have, massive profits as well. So something to look for next year, I guess, as well. The second
Yeah,
point
that's
here
the
is,
theme for the market.
yeah, that's the theme, right? Buybacks and dividends. It's not a secret. We've been saying this for a long time also.
True.
The other thing I want to address is timing is for losers. And for all of the people giving me shade on LinkedIn and other social media platforms, you are all bag holders for wealthy interests. So David Tepper slammed the table, told everybody buy everything, MCHI, ASHR, KWeb, they're all down 9.3, 6.8, and 14.5 points respectively since David Tepper said to buy everything. So you are a fool. We've been talking, like you just mentioned, about bottoming, as in the market may stop going down, but that doesn't mean it goes up. The confluence of events during the first week of October led to some optimism. Unfortunately, it was short-lived, and we're seeing that, eat away at those quick gains. So, David Tepper's a smart guy. He's got a ton of money and he can do whatever he wants, but that doesn't mean you should listen to him all the time. Market timing is notoriously difficult. And, back in the day, we used to call that front running. When I'm a big holder, I buy in and then I tell everybody else to buy in. We used to call that front running, and you used to go to jail for that. But now it seems like that's a strategy, one that I would not recommend you follow. I don't know if you want to say anything about that, Pengguo, but I
Yeah,
feel
I
very
totally
strongly
agree
about
with you. Like the one point. Don't listen to some big name or some famous person's suggestions, opinions. So as long as if you know that's its kind of opinion, don't trust it. It's easily give you like the misguidance and the wrong direction, and doesn't have the right timing to get into and exit from the market. And even in the uptrend of the market or from the index performance, the volatility is still high. So it's almost like the Sharpe ratio is around one. So that's you take the risk. It might be if you're in the perfect situation, it's cover the benefits, just to cover the risk you can take. So it's pretty much really hard. So investing in China is not the easy thing. Or you should purchase like the fixed income. We talked many and times before and adjust the volatility to affordable level.
Yeah, affordable volatility. Yeah. So the last point I want to bring up, and it's something we've touched on a little bit in the past, is brands are not stocks. The Chinese stocks that most foreign US investors can recall are some of the worst investments. They may be good companies, and we've said that, but stock performance is not necessarily linked to earnings. Alibaba, largely considered one of the best companies to come out of China. Baidu, the so-called Google of China, Pinduoduo, now more commonly known as Temu, all underperformed this year. On the other side, Meituan and Tencent outperformed. Stock picking, even among the top names, is extremely difficult. So you have names like Alibaba that everybody was saying, oh, it's cheap and oh, they make a lot of money. That stock underperformed the CSI 300 this year. So it's not only difficult to time the market, it's difficult to pick stocks. So we all think that that's a fool's game. And there's a lot of confirmation bias out there. There's a lot of people that I bought something, it went up, I'm a stock picker. In reality, you bought something, it went up, you got lucky, and hopefully you sold out of it. Um,
Yeah, I think one straight point is the growth rate is low, or expected growth rate is low for those big names. Obviously, I think if anyone have the research to disclosure why the big company linked to the bad stock performance,
yeah.
that should win a Nobel Prize.
No, that's exactly right, Pungwa. There's guys there's analysts screaming. They're using fundamental analysis, telling you what a great, low PE, great earnings, all this but that doesn't mean it accrues to the shareholder. This is the part of the problem that goes on and on and on. And we've demonstrated just this year, super cap tech outperformed small cap tech. The biggest names seem to do really well. The upstart names, it's hit or miss. And that star board, if you take a look at that, you're going to see a lot of the companies that are listed there are startups heavily influenced by technology. It's just underperformed, and that's the fact. So at the end of the day, you're looking for returns. You're not looking to be early. You're not looking to have some novelty. You want to get returns, and that's why your allocation. And then the final point is, like you said, the expected return, the expected growth rate has come down for China. So your expected return should come down as well. Well, we're going to leave it there with show L7. Thanks for tuning in. Everybody have a great Thanksgiving, and we'll see you next week.
Thank you.